I'm Jeremy Shepherd.
And I'm Damien.
We use data to expose deceitful property experts and their marketing BS. This is the Expert Busting Series.
I hear investors say all the time, just buy more land. Land matters. But size alone isn't what drives capital growth. Jeremy.
That's right, it's not. I mean, it's important, no doubt. Land is important. But the focus of investors is on the square metres, and that's not what drives growth, long-term growth. First of all, I want to start off with depreciation and appreciation. So you've no doubt been taught that buildings depreciate over time. They get older and they lose value, but land appreciates. Appreciation is just another word for capital growth. And so what you're after to maximise your capital growth is you would have heard a high land component. The argument being that because buildings depreciate and land appreciates, you want more of your money allocated to the thing that is appreciating, which is the land. Now, there's nothing wrong with that concept. But then what should we as property investors be buying? Is it houses instead of units? Is it houses on bigger blocks? Or is it just pure vacant land? What exactly is it that this high land component term is talking about? And that's where investors get misled. So most investors, they assume this to mean you should buy houses instead of units, and that's not a bad start. Historical data has shown that houses have outperformed units, and part of the reason for that is probably due to the land component. But another might be the relative potential for oversupply that you get in unit markets. So some investors aim for houses rather than units. Other investors aim for houses on bigger blocks. And that's also not a bad general strategy, but even that misses the point. Some industry professionals recommend buying a property with an above average block size for that suburb. Now, that's regardless of whether it's a unit or a house. All of this is missing the point, which we'll come to in a few slides' time. But firstly, as an interesting aside, I read a blog, this is going back a few years now when blogs were a thing, where this apparent property investment expert claimed to have discovered the ideal ratio of block size to house size. And you wouldn't believe it, they just coincidentally happened to be selling properties with that exact ratio. So there was no evidence given as to how they came up with this perfect ratio. In fact, I don't know what makes it perfect. What's the target variable here? Is it capital growth? Is it cash flow? I don't know. They didn't divulge any of that. I'm pretty sure they didn't do any research. In fact, I don't think this came from their research division. My guess is it came from their marketing division. Anyway, so be aware of misleading marketing. They'll package it up as if it's education. It's just BS. So there's a lot of nonsense that gets broadcast about. Hopefully this presentation will set at least one of those wrongs right.
Blocks of land.
Yeah, let's start with raw land as an option. So no building on it, just bare dirt. Do you think a block of raw land would have a high land component? Obviously it's 100% land. So how about a great big slab of Australian desert? Massive square metres, in fact square kilometres. How do you think that might have performed over the last, say, 20 years, for example? I can't think of a time in the last 40 years where I've heard of a large piece of Australian, very remote, regional area, square kilometres, growing as fast or even faster than, say, some of the big cities or significant urban areas in regional markets around the country. So obviously, therefore, the largest number of square metres is not the answer. Otherwise, the desert wouldn't be near worthless.
I guess there could be a debate. For example, let's say 15, 20, 30 years ago, I bought acres out, let's just say as an example, Kellyville or out that way, and it's gone crazy. There's no
There's always outliers. There's always exceptions to the general rule.
I think that's the thing. There's always outliers. So I know a lot of people think, units in, for example, Perth and Townsville and all these other markets have done really well. Yeah, the last year they've done close to even actually outperforming houses just because of the affordability at the time of recording of January 2026. But there are always outliers. So we don't say it always happens. There's always these outliers, right?
Yeah, that's right.
And you can do your research.
Yeah.
Right.
So the general rule about the lottery is you play, you lose. That's because of if you take a large population, most people lose. But there are outliers. Some people win.
The example I like to use is when I used to live in Melbourne, out Donnybrook way, north of Melbourne, just farmland farmland. Like there was nothing but a couple developers on each of the different projects there. And look, I haven't been there for 5 years now, but all I remember was it was just farmland. You wouldn't touch it.
Yeah. So my point here is that we're looking at some historical data. It's not the number of square meters that's the goal, because this highly rural, remote locations, these locations simply haven't kept up to pace with stuff closer to the cities. Now, that's not to say that developers don't buy vacant land for their house and land packages. They do, but these greenfield estates are on major city fringes, and they might be hectares in size, but they're not square kilometres in size. So clearly raw size on a large scale is not the key to growth. Okay, so what about land in a major city like Sydney? Well, there are a few problems. That's the right size, a slide, yeah. So there are a few problems with just buying raw land from an investment perspective: finance, rent and tax. So let's look at each one of those. I've got a separate slide for each. Yeah, so firstly, it's hard to get finance to buy land unless you plan to build on it. So leveraging more from a good investment is often not possible. Secondly, without a property on that block of land to rent out, how do you earn any income from it? And that's part of why lenders do balk at it. And that leads to the third point. If an asset doesn't generate income, you can't claim expenses related to that investment as a tax deduction. So that's interest on the loan, that's council rates. You probably wouldn't have any insurance for a block of land, but there's nothing else that's tax deductible. So any expense related to that asset would not be tax deductible. Legal fees, accounting advice, all that sort of thing. So now, just want to clarify, land is not a terrible investment. It's just that it has some issues which might not make it the best investment.
The challenge I've seen in the past is I've had clients where they've just sat on a block, but they want to accumulate their property portfolio, but they can't grow the portfolio because they're sitting on this block that's just doing absolutely nothing and hurting their cash flows. So they've got the whole idea of maybe Airbnb it or having a holiday home down the track, but different story if you're already comfortable, have 3-4 properties, things are going well and you can hold on to that block. But I would say that that's just most probably one of the big negatives. On the positive side, you can put money down on a block, gets registered in, let's say, a year or a year and a half, and you might have bought the block for $250. Now it's worth $350. You go back to the lender and say, hey, I'd like to take out some equity against the block and then build a home on it. So you can actually get in really cheap, but it's a lot harder to do these days. Back in maybe 2016, 17, 18, in a lot of these new land releases in New South Wales, easier. Now, good luck because a lot of the demand's already hit those pockets.
Right.
Well, you look at areas like Austral, for example, like absolute fortune now to get in there.
Right, yeah, okay.
Yeah, so the earlier you can get into a lot of these new estates, the better. But again, you've always got that supply risk. But the builders can't keep up these days. So,
all right, so what should investors really be looking for then? Well, it's not the number of square metres and it's not the block size versus the floor size. That's a crazy ratio nonsense. It's actually got nothing to do with square metres at all. It's to do with dollars. So it's where are your dollars allocated? Are they allocated to the land or to the liability, dare I say liability? And here's the big metric that you should be focused on. Drum roll.
Land
to asset ratio. So what you're really after is the highest possible land to asset ratio, or LAR for short. So properties with a significantly higher land value compared to the total assets value will outperform similar properties in the same suburb, even in the same street. I'll show an example soon, but first, if you could just move on to the next slide. This is just how we define this metric. So let me just back up a bit. If you've ever seen a professional valuation report, you'll have noticed that the valuer might qualify the land value as opposed to what they call improvements, which is the value of the building that's been plonked on top of the land. So improvements is the word they use for buildings. So with a value for the land and a value for the improvements, we can now more accurately define the land to asset ratio as, in this example, let's say you've got a property valued at $500,000. The land might be valued at $200,000, and the improvements, that's the building on top of it, valued at $300,000. So the land asset ratio in this example would be 40%, since $200,000 is 40% of $500,000, the total assets value. And by the way, this is a very low LAR. I wouldn't touch a property with an LAR this low. You want at least 60%. The higher the better. In fact, I remember reading another blog, a developer, of course, and they were bragging about their high land to asset ratio. It was 30%. I just thought 30%, if it was twice that high, might be interested. Why would you brag about 30%? It's just terrible. Anyway. All right, so why do we look at it? If you go to the next slide, please, Damo. Why are we looking at it this way? So remember how land appreciates and buildings depreciate? Well, we want the highest proportion of our asset appreciating and the lowest proportion depreciating. So we want as much of our money going towards acquiring an asset and as little as possible going towards, I'm calling it a liability. I mean, an asset appreciates, for example, land. A liability depreciates, for example, a building. Now, that might be a little unfair to say the building is a liability. After all, the building does generate income and the land does not. The thing is, capital growth trumps rental income. Rental income will not hasten your early retirement, your early financial independence. So investors should prioritise growth.
You'd call it a depreciable asset. You wouldn't put it a liability.
Right,
Liability is on the negative from an accounting side.
Yes, that's right. From a strict accounting perspective, because it generates income, it's not really a liability.
You're talking more about here is that land goes up and the building component depreciates over time.
So if you were purely interested in capital growth, you would have to view the building as a liability and the land as an asset. But technically, from an accounting perspective, the building is an asset because it generates income.
Yeah, talk to your tax accountant, but typically if you built like a brand new house on a block of land and it was an investment, you could claim that building component against your tax return over the 40-year period. So 2.5% per annum. That's just the building component, and then you've also got your fixtures and fittings also, but you can obviously talk to your tax accountant about that.
Yeah, and bear in mind that when you claim this as a tax deduction, you don't get it all back. You don't even get half of it back. So it's still a loss. You're still worse off. So if you claim $10,000 in depreciation in 1 year and you're paying 40 cents in the dollar, you will pay $4,000 less tax by making that tax claim. That doesn't mean you're better off by $4,000. It means you're worse off by $6,000, but you're only worse off by $6,000, not worse off by $10,000.
And you can buy new and outperform the national average. We're not saying that, like I said, there's outliers, but if we had, let's say, $1 million to spend, we wouldn't go buy a house on a block for an investment, right? We'd buy something that's already older, the value's in the land. That's what we would target because it gives us the highest probability of capital growth moving forward. And
for a really comprehensive rundown on that, check out episode number 3, New versus Old.
Alrighty.
Episode in the Expert Busting series, sorry. Yeah, so the amount of growth comes from a high land asset ratio. This is a concrete example here. So imagine property A is like the one I described earlier. It's worth $500,000. It has $200,000 worth of land. So it has a land asset ratio of 40%. Now, property A in this infographic, that's the $500,000 total value, land only $200,000. That means the building must be worth $300,000. So calculating the LAR, we get 40%. Now compare that to property B that's also worth $500,000, just like for like comparison. However, property B's value consists of $300,000 worth of land and $200,000 worth of building, which results in a land asset ratio of 60%. So two properties, same total value, but property B has a higher land asset ratio than property A. So how could that be possible? Well, property B might be, might have a smaller house on it, or might be older, it might have a bigger block, or the block might be in a better location, so it's valued higher. Now, this is at year zero. So we've got 40% LAR and a 60% LAR, $500,000. We're both starting at $500,000. So the left column on this graphic is the start year. The right column is after 1 year. Now let's see how a year has changed the values of property A and property B. Let's assume that the land for both properties grew by 10% over that year. Let's also assume that the buildings depreciated by 2%. Now, normally newer properties depreciate faster than older properties, but just to keep things simple, they both depreciate by 2% over that year. So after 1 year, property A's land has grown by 10% from $200,000 to $220,000, whilst the building has depreciated from $300,000 to $294,000. So that's a decrease of $6,000, which is 2% of $300,000. So the total value is now $514,000. And you'll also notice that the land asset ratio has improved. It's grown from 40% to 42%. Property B's land has also grown by 10% from $300,000 to $330,000. And the building has also depreciated from $200,000 to $196,000. So the total value of property B is now $526,000. So note the difference in prices now after only 1 year. Property B has outperformed property A, even though both properties had the exact same rate of appreciation in land and the exact same rate of depreciation in building. The reason why B had almost double the growth of A is because property B had a significantly higher land to asset ratio. And note how the land to asset ratios have changed now. The value of the land has gone up and the value of the building has gone down, so the LAR has improved in both cases. And the longer you own a property, the higher the LAR will get until you either renovate or knock down and rebuild. Damo, I can see you thinking about something.
Yeah, I am thinking. So the only thing this doesn't take into consideration, and again, it's outliers, there can be that emotional aspect to a newer property. I don't want to live in an older property. I'm willing to pay a premium. So if you've got, let's say, 10 offers going in on that property that has that higher building component because people are more emotional, it's got the theatre room, it's got the 4 bedrooms, that can be a bit of a factor into the price too. But like for like overall, we're talking about LAR here, the land to asset ratio, but it's just something to factor in that if you do have that sort of side-by-side comparison, people can get emotional with the...
Well, it's that interest in new property that makes new property a bad investment, because let's say everyone loves new property, nobody wants old property. You buy a new property, next year it's not so new, next year it's even less new.
That's right.
Next year. So the thing that you paid a premium for is now disappearing, it's evaporating. So people do prefer to live in new property, and that's why you shouldn't buy them, because they depreciate, they get older. You can't own them for a long time and benefit from them being new all the time, because they're not. That newness goes away.
There's always that market, right? For example, like new cars. People can't afford a new car, but they'll go finance it. They don't want that used car. They're willing to pay a premium. Obviously, there's a lot bigger supply for cars. especially with a lot of them coming from overseas. But agree with you, Jez.
Yeah, they depreciate.
They depreciate.
The very thing that people find attractive is just fading away.
Yeah, or like you see, buy that brand new car now for like 80, 90,000. In 10 years' time, you'll pick it up for 10 to 15,000. So if it's been maintained well, it's got the history books, there's nothing wrong with that car. So, yeah, it's good. Land to asset
All
ratio
right,
outcomes.
yeah, so good versus bad.
Good
So the
LVR.
focus is on a high LAR, not high square metres. And that is why, oddly, some units actually have high LARs. So just remember that it's not the square metres. It's calculated based on dollars, not on square metres. That's what matters. So most units won't have a very high LAR. The ones that do are in small boutique blocks, and they're usually very old. Now imagine a high-rise apartment complex built on a block of land worth, say, $20 million, and there are 200 units in that complex. So each unit, therefore, has a land value of only $100,000. Now, if the unit cost an investor $500,000 to buy, then the land asset ratio is only 20%, which is appalling. And as a result, the growth is usually appalling too. Contrast that with a group of, say, 12 units in a 3-story walk-up boutique complex. If the land was bought for $2.5 million, let's say $2.4 million to make the numbers easier, then each unit has a land value of $200,000. So if they're still priced at $500,000, they have an LAR of 40%. And that's still very low, but it's twice as good as an LAR of only 20% in the high rise. And interestingly, the houses with the highest LARs are also old, which makes perfect sense when you think about it. Older dwellings have already depreciated and lost much of their value. All that time they were depreciating, the land was appreciating. So over time the LAR gets higher and higher. So if you have bought a new property, wait long enough and eventually the land asset ratio will creep upwards. All right, so right now the penny is probably dropping amongst some of you that the old age debate, new versus old. If it still hasn't dropped, check out episode number 3. I mentioned that earlier. It's in this expert busting series. New versus old is the title of that, episode number 3. And that's why you should not buy new properties. All right, there's a similar one on why you shouldn't chase after properties with high depreciation. They're called high depreciation benefits. There's nothing beneficial about depreciation. Depreciation is detrimental. Appreciation is beneficial. So that's episode number 7. Check out episode number 7 in this expert busting series. In summary, new properties have a higher building value, therefore a lower land asset ratio. Older properties have higher valued land and lower valued building, and therefore have a higher land asset ratio. And don't think that depreciation claimed against your income is a benefit. It's a detriment. So don't get those two confused. I still find myself every now and then saying depreciation benefits. It's a misnomer brought into the industry by property developers. It's rubbish. All right, in conclusion. So the LAR is a pretty straightforward concept. A little hard to argue against when the maths is so easy. So how come this is such a poorly understood concept, not common knowledge among property investors? So remember what I said about the nonsense being broadcast around. Imagine you're a property developer and you're trying to flog off some stock to uneducated investors. Teaching them about the LAR isn't going to help you sell anything, and that's when their BS starts. So if you're interested in protecting yourself against more of this sort of BS, check out some of those other topics in this series that I mentioned, in particular episode 3 and 7. Damo.
Alrighty, so that was, I think you made all the good points there. The land size is the big one. My only takeaway is that
land value
is what we're after.
Dollars.
Yeah, because
dollars, not meters.
Dollars. And another example we could use is, let's say we use Marrickville as an example in New South Wales, Sydney. the block size are really small, but the value is so
Yes, good
high.
point.
But then you go really, really far away. But look, there's areas you go down as far as Bateman's Bay as an example. So you'd have to sort of work out what's the dollar per square meterage on the land. But supply is a big issue, right? That's the biggest thing. I think that desert example that you used, or the Donnybrook example that I used, just watch out for that constant farmland. So next up in the expert busting series, I think it's 22 market cycles, when to pivot to a better market. Thanks for watching.